If I can just earn average returns for an above average period of time, it's going to lead to an amount of success that will literally put you in the top 5% of investors.
Parking tickets, erratic shopping, unnecessary subscriptions, membership fees, and regular takeouts. There are over 1 million ways people waste money on unnecessary expenses nowadays, with the flimsy excuse that it's only a tiny fraction of their wealth. However, little do they know that each of these expenses was a wasted chance to gain wealth. Yes, you heard that right. That crisp $100 bill in your hands that's screaming to be spent can transform into a wealth-generating powerhouse. And no, we're not talking about complex investment strategies or waiting for a stroke of luck. In today's video, we'll be diving into how you can gain financial independence with just $100, debunking the notion that significant capital is a prerequisite. And no, we're not promising get-rich-quick schemes. Instead, we'll explore practical strategies to efficiently multiply your humble investment. And guess what? It's easier than you think. When Morgan Housel wrote his book, The Psychology of Money, little did he know that it'd be a bestseller, selling over 3 million copies worldwide, and get translated into 53 languages and counting. But it wasn't just a coincidence. His pages didn't just happen to be liked by millions of people. Rather, it made a significant impact by helping individuals to reflect on themselves and better understand the human side of finance. It was a simple, yet efficient way to make people understand how money works. And by closely studying Housel himself, we couldn't help but notice stark similarities. When it comes to investing, Morgan Housel loves to keep things simple. And as a matter of fact, his net worth is basically a house, a checking account, and index funds. On paper, it might feel a bit too easy, but make no mistake, it's a tested and trusted strategy, and one that a lot of winning investors can get behind, despite the fact that a lot more people shy away from it because it seems unambitious. Morgan Housel's interest in investing began in his late teens when his grandparents gave him $1,000, and he decided to invest it in a short-term certificate of deposit. To his surprise, the next day, he found he had earned 3 cents in interest without any active effort on his part. It was a mind-blowing discovery. He had made passive money that would only get bigger with each passing day, all without moving a finger. But sure, $100 and $1,000 are two completely different starting points. One is seen as a meager sum for investing, and the other, well, not so much. But regardless of that, stable wealth-generating principles are cut in stone and work for any kind of capital, be it 4 digits or a humble 3. And the earlier you start putting these into practice, the better your chances of success are. If you pick up a random finance book on how to make money, we're almost certain that the first step will be a pretty cliché section on how to get a job or jump into stocks in the hope of striking gold. But we don't agree with these. If there's one thing we learned from Morgan Housel, it has to be that self-introspection is the cornerstone of success and the bedrock in which one can build a prosperous and fulfilling life. And he puts it in this beautiful way.
So if you become more introspective about who you are and what you want out of life and what money can do for you and cannot do for you, and become a little bit more introspective about why you think about where you are in the social hierarchy, and greed and fear, and why you think about these things that you do.
At its essence, this step involves a deep and honest examination of your values, strengths, weaknesses, passions, and long-term aspirations. And believe it or not, you simply can't win without it for a lot of reasons. To start with, understanding yourself gives you a compass for decision-making. Without a clear grasp of your personal values and goals, how would you be able to make your money work? Randomly setting goals that don't resonate with your core beliefs is only a waste of time. Before you put your money anywhere, it's crucial to clarify hard questions like, why are you investing this money? What financial goals do you want to achieve? And also the time frame you're investing in. Is it a year, 5 years, or more than 20? Knowing your required time frame can help determine how aggressively you need to invest. If you want to grow your money over decades for retirement, investing primarily in long-term assets like stocks makes sense. The longer runway lets you ride out near-term volatility. And once you've had that all-important sit-down with yourself, the next thing you need to be careful about is understanding the difference between being rich and being wealthy. Sounds similar, right? Think again.
But I defined rich as you have enough money to buy what you want, to pay for your mortgage, to make your car payment, to go out to dinner with your friends. You have money in the bank. Wealth, I think, is very different. Wealth is money that you did not spend, and maybe you will not spend on jewelry. And that's really important because wealth that's saved up, the unspent money, is what gives you independence and autonomy and just the ability to wake up every morning and do whatever you want.
Contrary to popular belief, being rich and being wealthy are not the same. According to behavioral expert Morgan Housel, if you're wealthy, you have a lot of money in the bank. And that's why he describes it as the kind of money you're not using, but you could if you wanted to. However, when it comes to being rich, it means that you've got a high income that enables you to afford expensive items. And funny enough, it's possible to gauge if someone is rich by observing their spending habits, because you can see their assets. But you wouldn't be able to tell a wealthy person because you can't look into their bank accounts. Believe it or not, no one truly cares about the kind of car you drive or the luxurious house you live in. Rather than keeping you on a high pedestal, they're actually imagining themselves in your position, driving your Ferrari and living in your house. Take a look at how Housel puts it.
Is thinking about you as much as you are. Nobody cares about your stuff as much as you do. Nobody cares about your car or your house or your clothes or your jewelry as much as you do. Because to the extent that they're even looking at them, they're looking at your car, looking at your house, really what they're doing is imagining themselves with that nice car. They're not giving you the credit. They're imagining themselves having it.
People who are actually wealthy have bought into the keys of true wealth accumulation. And based on experience and validated by Housel's teachings, these keys include living within or below your means, staying away from any kind of debt, and finally saving aggressively. That said, the beauty of the aforementioned points is that once you've got them in check, you're already 25% through on your journey to lasting wealth and success. The remaining 75%, however, is the real deal. And according to Housel, only one thing matters.
Is not what are the best returns you can earn. All that matters is what are the returns that you can sustain for the longest period of time. All that matters is your endurance. It doesn't matter if you can double your money this year or even double your money again the next year. All that matters is, can you stick and keep it going for 50 years? That's where compounding comes from.
Over the years, we've given a lot of thought to what it takes to grow wealth. And after analyzing and modeling the lifestyles of several members of the top 1%, their saving and investment habits, and their work patterns, one common denominator that we couldn't help but notice is that they all believe in the principle of compounding. For the benefit of novice investors, compound interest refers to the interest earned on both the initial investment and the accumulated interest from previous periods. It multiplies over time, influenced by the given interest rate. Let's say you invest $100 with a 7% return in a year. You'd earn $7 of interest during that initial period, and by the end of the year, you'll have $107. And if you reinvest that $107, you'll have $114.49 at the end of your second year. You may think it's a meager sum, but the key to multiplying your wealth quickly comes from starting as early as possible, because the earlier you start saving, the more compound interest can work in your favor, even at relatively low amounts. Here's a pretty good example of how this works. If you start saving $100 a month at the age of 20, with an average annual return of 4% compounded monthly over 40 years, you would accumulate $151,550 by the age of 65, with the initial investment of $54,100. Compound interest plays a significant role in wealth accumulation over time. But let's say you have a friend who didn't start investing until he was 50. After an initial investment of $5,000, he then invests $500 monthly for 15 years, also averaging a monthly compounded 4% return. By the time he gets to 65, he'll only earned an excess of $132,000, with a principal investment of $95,000, despite investing almost twice the amount of your principal. Now, don't take this to mean you're not going to make a lot of money if you're already in your 40s and haven't begun compounding. 99% of Warren Buffett's wealth came after his 60th birthday, and today he is worth $119 billion and is still going strong at the age of 93. His skill is investing, but his secret is time and consistency. Uninterrupted consistency is investing in the fuel that powers compounding, And compounding is the primary driver of nearly every long-term success story. Remember Ronald Read, the janitor who died as a secret millionaire? In his lifetime, he lived way below his means by maintaining a frugal lifestyle and never spending money unless he had to. He drove a used Toyota Yaris, used safety pins to hold his coat together, and even cut his own firewood well into his 90s. If he earned $50 in a week, he'd invest $40 from it while practicing the ability to hold on to stocks for the long haul, a strategy Warren Buffett recommends. At the time of his death, he owned at least 95 stocks, many of which he patiently held for years, which in turn grew his wealth through the power of compounding. To give you a better idea of the power of time and patience, how about we imagine that he was earning an annual growth rate of 10%? When his assets reached $500,000, a 10% increase meant a $50,000 gain, bringing the total to $550,000. However, at $1 million, the same 10% gain equated to $100,000, resulting in a total of $1.1 million. The impact is magnified with larger sums, such as a $300,000 gain at the $3 million mark and a significant $500,000 increase at $5 million. Guys, it's not rocket science. If a janitor could become a millionaire through compounding, so can we. And the best part is that you don't even need to be a genius stock picker. Endurance is always the king. And if you think otherwise, you might want to listen to this.
If you have endurance in your investing and you can keep it going for years or decades, you don't need to be a genius stock picker. And not only do you not need to do it, if you have endurance, you're going to beat literally 97 or 99% of the genius stock pickers.
While there are several ways to make money from humble capital, one method has proven to stand out. And we are, of course, talking about index funds. There's a reason why some of the biggest investors in the game, like Warren Buffett, who practice discipline, patience, and value. They always believe low-cost index funds are a savvy choice. And in the world of investments, time is a formidable ally, and index funds harness its power. While one can argue that stocks are probably the most powerful wealth-building tool the average person can buy, it's also really hard to pick the winners. And if you're only investing $100 or even less at a time, it might not even be worth the time and effort to choose individual stocks. And that's where index funds come in. When you invest in a stock index fund, you buy a piece of every company held in that index. For example, if you allocate $100 to the SPDR S&P 500 ETF Trust, you'll own a small fraction of each of the 500 companies listed in the S&P 500 index. This approach provides immediate diversification and aligns with a long-standing track record of delivering returns for those willing to hold on to their investment for a decade or more. And the best part is that this diversification acts as a perfect buffer. By spreading your investment across a variety of stocks, they cushion the impact of underperformers, ensuring a smoother ride towards your financial goals. Once you've established a robust foundation of the best index funds and made a lot more money from them, you can branch out and explore other investing options. And with that being said, here's another helpful tip on your journey to wealth creation that you need to know.
Make sure that you have a big enough buffer in your finances, cash, liquidity, being scared of debt, so that no matter what happens, you at least have a fighting chance of enduring it and making through. One thing I've often thought about is that you should have enough cash in your investing portfolio. The amount of cash you should have should feel like it's too much. It should make you wince a little bit.
For as long as we can remember, Warren Buffett has been a proponent of holding cash. As a matter of fact, Berkshire Hathaway has always maintained a minimum of $20 billion in cash in its portfolio. Maintaining cash reserves, especially for aggressive investors, offers the advantage of liquidity, enabling them to make opportunistic purchases when company valuations decrease to attractive levels. A notable example of this is Warren Buffett's acquisition of 1.6 million shares of Wells Fargo & Company at an average price of $8 per share in 2009. By June 29, 2016, the share price of Wells Fargo had risen to $46 per share. Plus, the liquidity provided by holding cash also presents the opportunity to make purchases using dollar-cost averaging plan, And this could be an amazing opportunity for investors, because dollar cost averaging's primary advantage lies in acquiring more shares when prices are low, and purchasing fewer shares at higher prices.